Welcome back to Investing Talk Podcast. Today we are zeroing in on energy fuels. Now, this isn't just any mining company. They're positioned, well, right at this really critical point between modern energy security and strategic critical mineral independence. So our goal today is pretty straightforward. Cut through all the noise and tackle a question you've been asking. Is energy fuels a good time to buy right now? We've gone through their latest financials, their operational news, market buzz, basically giving you the fast track to understanding the stock.
And that dual focus you mentioned, that's exactly why they demand this kind of close look. They're in two incredibly strategic markets. You've got uranium for energy security, obviously, and then rare earths, which are just, well, non-negotiable for everything from green tech to defense. So understanding how they juggle both, that's really key to the whole analysis.
Absolutely. Okay, before we dive into those pretty hefty financial figures, just a quick reminder. If there's a specific company you're curious about, one you want us to look into, drop us a comment below. And please, subscribe and like this analysis. It really helps keep these insights coming your way. Okay, let's get into it. The last 3 months for energy fuels, wow. The sources point to just a huge financial transformation, plus some really major operational steps forward. Let's start with the money. That move in October 2025.
Oh, that was definitely a game changer. They pulled off this transformational upsized offering. It was 0.75% convertible senior notes due 2031. And they raised, get this, an aggregate principal of $700 million. That wasn't just raising cash. It felt like a major signal of confidence.
$700 million. But why convertible notes specifically? Why not just, issue more stock?
Right, good question. And that's kind of the clever part. Using convertibles lets them grab this enormous war chest, this financial muscle, without immediately hammering existing shareholders with dilution. And more importantly, it signals to the market they think their stock price is going way up. Because, eventually those notes might convert. They're betting on their own future success. It gives them huge flexibility, runway, basically.
Okay, so that's the financial runway. But what were they actually doing on the ground? August 2025 seems like it was pretty exceptional operationally. Yes, they reported a Q2 net loss, $21.81 million, which, reflects those big investments we talked about. But the Pinyon Plain mine, the performance there was almost shocking.
It really was a testament to the quality of that asset. Pinyon Plain churned out 180,000 pounds of uranium. But the number that really jumps out is the grade, a record-breaking 2.23% U3O8.
Okay, 2.23%. Put that in perspective for us. Why is that specific number such a big deal in the uranium world?
Well, to give you an idea, the industry average for conventional mining, it's often way down, like below 0.1%, sometimes even lower. So we're talking about ore that's literally maybe 20 times richer than what's typical.
Wow, 20 times.
Yeah, it means their existing uranium assets are incredibly high grade. And that translates directly into potentially lower operating costs, higher efficiency, even before you factor in rising uranium prices.
And just as they're hitting peak efficiency in uranium, the rare earth side delivered something maybe even more historic that same month, right? August again.
At Dysprosium News. Yeah, that was genuinely momentous. In August 2025, they produced their first dysprosium oxide. Now, dysprosium, it's a heavy rare earth. Absolutely critical for high-performance magnets, big defense systems, high-efficiency motors, the really advanced stuff. And the key thing, they're the first U.S. company to publicly announce high-purity dioxide production. It's a real tangible step towards, a non-Chinese supply chain for these materials you just can't substitute.
And they didn't stop there. By September, just a month later, they'd successfully commissioned their commercial-scale light rare earth circuit at White Mesa Mill, producing NdPr oxide.
Exactly. Neodymium, praseodymium. That's the stuff driving EV motors, modern wind turbines. Big demand there. And they didn't just make it. They also advanced their supply chain. They started sourcing non-Chinese monazite sand, the raw material, from places like Florida and Georgia. So it's not just processing. They're actually building out the whole North American supply chain, sort of end to end. You pair that operational progress with that huge capital raise, and the balance sheet looks incredibly strong. As of September 2025, $253.23 million in working capital, and critically, zero debt.
Okay, here's where it gets really interesting, though, because you've got this picture of massive financial liquidity, operational breakthroughs, but you also mentioned that Q2 loss. How do we square that momentum with the fact they're still technically losing money?
That's the tension, isn't it? It's really the core of the whole investment story here. If you just look at the trailing 12 months, yeah, the numbers are starkly negative. TTM net income is minus $93.1 million. TTM earnings per share, minus $0.48. But you have to understand, this isn't like a regular manufacturing company where a loss like that signals disaster. This red ink reflects really aggressive but necessary spending. They're building out a whole new capability, diversifying into complex rare earth processing. It's highly strategic. Investors right now are basically paying for the future potential of that rare earth business.
Right. So a $93 million trailing loss, but analysts are still calling it a strong buy. Is this thesis really built on solid economics, or is it more about, say, government policy hopes, speculation?
It's definitely a VIX, but it leans heavily on what you might call their strategic competitive advantage, their moat, basically. First, that diversification we talked about. Uranium, vanadium, and rare earths. It positions them, perfectly for both the nuclear comeback and the green transition. They catch both waves. Second, and this is huge, is the national security angle. The U.S. government increasingly sees domestic nuclear fuel and critical minerals as, well, essential infrastructure. Pure and simple. This means Energy Fuels is really well positioned to benefit from specific laws, maybe government grants, maybe long-term defense contracts, things that kind of operate outside normal market forces.
And the operational moat must be pretty significant, too. I mean, trying to build a new facility like White Mesa Mill today with all the environmental hurdles, it seems almost impossible in the U.S.
Oh, absolutely. White Mesa Mill is the only operational conventional uranium and vanadium mill in the entire United States. And crucially, it already has the necessary permits. That means they don't face years and years of environmental reviews just to get started, unlike any potential competitor. That regulatory moat, it's practically priceless in this sector.
The market certainly seems to be buying into that bullish story. Looking at the technicals, the stock's been trading way above its 200-day moving average, which is down around $7.48. And also well clear of the 50-day average at $13.84. That definitely confirms a strong uptrend, technically speaking.
Yeah, it does. And the stock's been very active, high volatility, about 23.6% in the last 30 days alone. That shows a lot of speculative interest, right? And it's been positive, too, gains on 60% of those trading days recently. So yeah, momentum is strong.
Okay, let's shift focus a bit then. We've covered the explosive past 3 months. What are the key things you, as an investor, need to watch over the next 90 days? The near-term catalysts.
Right. The next 3 months are really about execution, proving they can deliver. Financially, you'll want to watch the Q3 earnings release. That's coming up in November 2025. And then the Q4 preliminary results in January 2026. These aren't just about the bottom line profit or loss, though. Investors will be digging deep for details on how that rare earth ramp-up is going and confirmation they're managing costs effectively.
And on the uranium operations side, what's the goal there?
Continued efficiency, basically. They need to show that Pinyon Plain keeps performing well. They're targeting production costs in that revised, really efficient range of $23–30 per pound. That should be achievable by Q4 2025. Hitting that target confirms their core uranium business is profitable, which provides a nice cushion, regardless of price swings.
But the really big growth driver, the one everyone's focused on, that's a bit further out, isn't it? Tell us about the heavy rare earth plan they announced back in October 2025.
Yeah, that's the long game, the really big prize. They announced plans to build commercial-scale separation capacity for dysprosium, terbium, and potentially other heavy rare earths. Right there at White Mesa Mill, the target completion for that is Q4 2026. This heavy REE separation, that's what really underpins the current sort of high valuation. If they manage to pull that off, they basically establish themselves as a permanent strategic bottleneck for a non-Chinese supply in the West. A huge deal. So short-term outlook, if this operational momentum keeps up and sentiment stays positive, the charts suggest the stock could try to retest that upper end of its 52-week range. That's up near $27. Technical support levels seem to be firming up around the $20 mark, maybe a bit lower.
Okay, so let's talk risk, because this is clearly, as you said, a high-risk, high-reward situation. What are some of the speculative things investors might be pricing in right now that aren't guaranteed?
Good point. The market is definitely running on anticipation. I'd say 3 key speculative catalysts really stand out. First, there's the hope, maybe expectation, they'll lock in more long-term uranium contracts with U.S. utilities, playing that domestic supply card. Second, anticipation of some kind of big strategic rare earth partnership, maybe with a defense contractor, maybe a major EV maker who's desperate for secure NdPr. And third, yeah, the possibility of a major government grant or maybe a low-interest loan, given their critical role in national mineral strategy. That's always humming in the background.
Those are definitely big potential upsides. But what about the flip side? The company-specific risks that could derail this whole story, even with $700 million sitting in the bank.
The execution risk is just. It's massive. You can't ignore it. Those continued net losses, the negative EPS, it underscores that their success depends entirely on executing this really complex, first-of-its-kind rare earth expansion flawlessly. Any major delays in bringing those new separation lines online or significant cost overruns, that could trigger a pretty severe market correction. Plus, they're still exposed to commodity price swings in their base metals, uranium and vanadium.
And we should also touch on the broader market risk, specifically its volatility. The beta is reported at 2.21. For listeners maybe not used to high beta stocks, what does that actually mean day to day?
It means buckle up. Seriously, though, it means this stock is definitely not for the faint of heart. Practically speaking, if the overall market, say the S&P 500, moves just 1% up or down, statistically, Energy Fuels is likely to move about 2.21% in the same direction. It just amplifies everything good news and bad news. It makes it very sensitive to sector rotation, overall market fear, that sort of thing. And while the analyst consensus is still a strong buy, you have to look closer at a really crucial detail. The consensus 12-month price target, it's only $12.70.
Wait a second. Analysts are saying strong buy, but giving it a target price that's, well, significantly below where it's trading now, near $25. How does that work?
Exactly, and that big gap, that disparity is really telling. It suggests the current high price is being driven heavily by short-term factors, that $700 million raise, the recent operational news, momentum. It's not necessarily based on conservative, long-term valuation models. It implies analysts are pretty cautious about how much of that future rare earth success is already baked into the current price. So yeah, synthesizing this whole complex picture, Energy Fuels is undeniably a high-risk, high-reward play. Based on its strategic importance highlighted in the sources, we'd give it an overall bullish rating, maybe an 8 out of 10. But that bullish case rests entirely on them successfully executing that 2026 rare earth expansion plan, and also on continued strength in the uranium market. Both need to happen.
Which makes the investment horizon absolutely critical for you, the listener, right? This stock seems extremely attractive for short-term traders who can play that volatility, maybe trade around earnings surprises in the next few quarters. But if you're a long-term investor, that high risk stemming from the current lack of profit, it demands really careful position sizing and a deep multi-year conviction in the strategic importance of what they're building at White Mesa Mill.
And that leads perfectly into the final thought we want to leave you with today. Given that high operational risk and the reliance on sometimes shifting government policies supporting domestic supply, how crucial is it for you to distinguish between the short-term catalyst, that huge $700 million cash cushion, and the multi-year, technically challenging long-term success of actually building out that rare earth separation capability at White Mesa Mill? Tracking that difference, keeping an eye on the actual physical progress towards that 2026 goal, that's really what you need to focus on next.